We just had a huge inflation dump on Thursday with both not only the GDP report but also Visa and Mastercard earnings. And with the Fed meeting less than a week away, this data can help us predict what we'll most likely hear from the Fed. Hi everyone, it's Jonathan here, and let's get right into the data. So let's first start with the GDP numbers. On Thursday morning, we got the Q4 gross domestic product first estimate numbers. So typically the way it works is that we usually get the first estimate about a month after the quarter ends. Then we get a second estimate about 2 months from when the quarter ends. Then we get the final number at almost the end of the preceding quarter. So about a new update once every month. Usually they don't change very much from the first estimate. There's usually little tweaks here and there. So this is a really good gauge for us to base some of our assumptions about the fourth quarter on. We got a 2.9% increase quarter over quarter in GDP. And that was actually a beat from the expectations of about 2.6%. But it is a decrease from the readings that we got in quarter three at 3.2% increase. So it shows that we are slowing down a bit from the previous quarter, but we are above expectations, so it does reduce a lot of the fears of a possible recession in the near future. So to break down some of these increases that we saw, we did see an increase in spending in private inventory investments. So think like raw materials to make finished goods or finished inventory that companies have. And this was mostly led by energy producers and utilities, which makes sense. We did have a really intense winter in Q4, so it does make sense that we did see a lot of spending in this sector. We also saw increases in consumer spending as well, both on the goods side and the services side. So on the services side, we did see an increase in healthcare, housing as a service. So when I say housing as a service, that's like lodging away from home. So like a hotel or an Airbnb or something like that. And utilities again, which is in line with what we saw in some of the other inflation reports as well. When it comes to goods, goods were actually led by motor vehicle repairs and parts. And I remember when we were covering the CPI report in December, I did talk about how we are starting to see this trend up. And my thinking behind it is the fact that because we've seen used and new car prices go up so much in the past couple of years, that now people are opting, instead of buying a different car, to just repair the car that they have currently. So I think that's some of the reason why we are seeing this category shoot up a lot, and we are seeing it play a big role in the increase we saw in GDP. So we also did see increases in government spending. On the federal side, we saw it mostly in non-defense spending. And then in the state and local side, we saw it mostly in wages. And this does align with what we saw with the JOLTS report, where it did say that municipal and state hirings are up. So there's really no surprise here. We did see an increase as well in non-residential fixed investments. So just think about this like machinery, commercial real estate, things like that. Pretty much business spend on fixed assets, like plant, property, and equipment. And we did see an increase, mostly driven by intellectual property. We saw it partially offset by a decrease in equipment, which does align with what we saw in the JOLTS report as well, as we did see a massive reduction in durable goods manufacturing jobs. So when it comes to decreases in spending on the GDP report, one of the things it did highlight was residential fixed investments. And it was mostly led by single-family housing, which we have seen a lot of pressure on single-family homes, mostly due to the aggressive rate hikes we got in the past year, and we still plan to get in the future, which we'll talk about more later. And also broker commissions, which again is tied into the single-family housing market. So when we get all of this data and we combine it with some of the inflation readings that we're getting, it does open up the possibility of the Fed reaching its goal of a soft landing, where it can bring inflation down without pushing us into a recession. If the Q1 or Q2 GDP reports are revised to the upside by the group of economists that decide if we're officially in a recession or not, and the Fed is able to get inflation down without pushing us into a recession, that would be the first time in history that has ever happened. You know, some of the most dangerous words in investing is "this time is different," but there actually is a chance that this time might be different. One of the more important numbers that we did get from this report was personal consumption growth. and in Q4 it grew 2.1%, or about 0.8% if you adjust it for inflation, which is lower than what was expected by the market. And this does cause some concern that the Fed may risk pushing us into a recession if they do continue down a path of very aggressive rate hikes. So it's kind of good news because we want to see personal consumption come down, because that usually means that inflation will go with it. But at the same time, we also don't want to end up in a recession either. So it's kind of this balancing act that we're playing here. So moving on to Visa and Mastercard earnings. Both Visa and Mastercard reported earnings on Thursday, and they both missed market expectations on spending growth totals. Visa only grew 1.7% quarter over quarter, whereas Mastercard grew 11% quarter over quarter. But both companies did mention that consumers are starting to buy lower cost generic items versus their name brand competitors to cut costs. But they're still seeing a boost in travel and dining spend as COVID restrictions start to ease up more for different parts of the globe, which is somewhat in line with what we're seeing in the inflation reports. We're seeing goods inflation start to come down, but we are still seeing service inflation stay elevated. So what does this all mean for the Fed? So recently the bond market has been on the fence between the Fed either pausing their rate hikes at the upcoming meeting or going through with a 25 basis point hike. Currently, the bond market is penciling about a 99.4% chance of us seeing a 25 basis point hike at the Fed 1 meeting. So there are some that are still calling for the Fed to do another 50 basis point hike, stating that the Fed needs to earn back credibility and that they must front load the rate hikes in order for them to not underestimate inflation. Now, in my opinion, I think in the next FOMC meeting, we're going to get a 25 basis point hike. I think that's almost definite. I think a 50 basis point hike would be way too aggressive because we are starting to see the positive data come in. So I think that would end up being an overreaction by the Fed. That's just my personal take. But I also do think it's way too early for us to start talking about pause and rate hikes. And generally speaking, I'm a little bit more on the dovish side of things. I actually think that the Fed needs to slow down. But I do understand them continuing on with another 25 basis point hike, given that there's just not enough consistent data to support pausing. And we have seen what happens when you prematurely pause with some of the inflation situations we had in the early 80s. So when it comes to the press conference, I do expect Jay Powell to continue to be hawkish like he has been over the past couple of FOMC meetings. The reason for this is because the last FOMC meeting in December, Jay Powell was being very hawkish and the bond market basically like almost blew him off. And they were just like, yeah, dude, whatever. We don't care what you're saying. And I think that because of that, the Fed really wants to make sure that they really tighten financial conditions and that they don't loosen too quickly and cause inflation to spike back up. So I do expect him to acknowledge that the data is showing that they're on the right path, but then he'll say something like, but there's still more to do. And quote me on that. I almost feel like he's going to say that verbatim, but we'll see. During the March FOMC meeting, I think that there's a much higher chance of a pause. If we do end up seeing inflation data start to move to the deflationary side much quicker. This data overall does support that the Fed may need to start looking into pausing very soon. Probably my guess would be within the next 2 to 3 meetings, or they do risk going overboard to the other side and end up putting us into a much more dangerous situation. So thank you so much for watching. As always, please like, share, and subscribe. And I'll see you in the next one. Peace.